Welcome back, everyone. Sorry, it's been a little bit. I was in Mexico for a week with my business partners. We were planning a 100-unit subdivision out of Arizona. So really had a hard time getting in front of the camera as we were heads down on that project. But I'm back at it, and today I want to talk about the relationship between risk and return. And right now in the market, I think as expected, due to a lot of stimulus, due to interest rates increasing slightly, due to inflation fears, due to the political risk with China and a number of other parties, it is expected to see a lot of volatility in the market. And coupling that with the massive amount of retail traders out there, it's a crazy time to be investing in the markets. And it's hard to make sense of all this. And so today, what I want to tell you, or at least talk to you about, is kind of the concept of the trade-off between risk and return. And I think it's probably generally known by most of us that obviously the more risk should mean more return, but it doesn't always have to be that one-to-one ratio. And what I mean is, if you talk to anyone who are traders and they tell you, hey, I beat the market last year, the market returned 15%, I returned 20%, great. But the question is, how active were you in your trading? How volatile was your portfolio? Was it up 3% one week only to be down 5% the next, and vice versa? That's not the kind of trading or portfolio that you want. And so when you think about returns, it is not as simple as to say, okay, I have a 15% opportunity here to make money, or a 15% return on my money. You need to think about what amount of risk did you take on, right? And this is why I'm a big proponent of something like private money lending, right? There's a collateralization in the asset, right? So you give your money and it's backed by an asset that you would get at a discounted price. It provides cash flow, right, as an opportunity. And if you had to take on the asset, there's margin in the deal for you to make profit. So really, in a variety of ways, you're protected on your profit and upside. Yet, from our clients, we're still making 16 to 20% on our money. So phenomenal returns, pretty consistent cash flow, minimal downside risk. That is one of my favorite investments because of that. Now, I also like stocks. I am investing in stocks, but it's been a ridiculous ride over the last 6 to 9 months. And this is why I said in a previous video, make sure you're dollar cost averaging. You want to be buying in consistently, allocating consistently so that you're hedging the volatility in your portfolio, right? And again, we're still estimating a 10 to 15% return in stocks. You just have to take on a lot more risk, okay? And now here's another one, owning real estate properties. Generally speaking, there's much more linearity and kind of just a consistent curve of appreciation and minimal risk within real estate. We have had the crash in 08. People are afraid of an upcoming crash, which again, I do not see happening. But in general, there's minimal risk with real estate. The problem with real estate is liquidity. It's hard to sell the project in a fast period. So you trade off liquidity, such as what you find in the stock market, very liquid, versus the risk. And so there's that component too. And I think what I'm getting at here across the board, when you look at your portfolio, obviously you should be diversified, but you also need to consider the amount of risk that you're taking on for the amount of return, right? Now, here's another example. In my development deals in Arizona and my bigger projects, the upside for my investors, it is 28, 35, 40% on their money. Substantial upside. But the amount of variables in the equation, the amount of risk is very substantial. A number of things could go wrong, and knock on wood, they have not to date. But there's a lot of risk that they take on to get those high returns. And that is the way it works, right? They're betting their money today for a return they'll get in 18 months from now. That's a risk. It's a big risk. And for that, they get paid for that risk. So long story short, what I'm saying is when it comes to risk and return, you have to weigh out the difference between the amount of return you get for the amount of risk that you have to take on to get that return. And so again, that's why one of my favorite investments is private money lending. I keep telling investors, I know it's boring. It's a very boring investment, but boring is what you want. You want a boring 15, 17, 19% return that just recycles. And in 5, 10 years, you look back and you say, I made a lot of money. It wasn't a lot of excitement, wasn't a lot of risk, but I made a lot of money. And that's kind of what we're seeking here as you build your wealth. So I would love to hear some of your ideas and thoughts about how you see risk versus return in the market. That's how I view it. And if you like what you heard, give it a thumbs up. Thanks, y'all.